Have you ever wondered why entire economies can rise or collapse based on decisions made by a handful of people you'll never see, in rooms you'll never enter, using models you'll never access? Because the truth is this: economic reality is not discovered. It is manufactured, shaped, edited, and quietly rewritten by central banks. Interest rates, inflation, recessions, recoveries — we treat these like natural forces of the economic world. But what if they're closer to scripts in a play? Scripts written behind closed doors. Today, we're going to uncover how central banks gained the power to rewrite financial reality, how they exercise that power without public oversight, and why the consequences of their decisions ripple through your life in ways you never realized. And the deeper we go, the clearer it becomes. Central banking isn't a system. It's a silent architecture of control, one that has evolved through crisis, secrecy, and decades of economic manipulation. Let's begin at the point where this hidden power first started taking shape. Central banking didn't begin with complicated models or trillion-dollar balance sheets. It began with panic. In the early 1700s, European economies were unstable. Wars drained treasuries, coins were clipped and debased, and trust in governments fluctuated wildly. Nations needed a solution, not to protect the people, but to stabilize governments and finance their ambitions. The Bank of England, founded in 1694, was one of the first examples. A private institution, lending money to the crown, in exchange for power. From the start, the pattern was set. Central banks rise when governments need money. They expand when crises hit, and they gain influence when the public is desperate for stability. But behind this comforting facade was a darker truth. They were rewriting the rules of money, quietly, incrementally, permanently. As centuries passed, other nations adopted similar models. But the turning point, the moment central banks truly began shaping economic reality, came later. It came in America. By the early 1900s, the United States was booming and chaotic. Bank runs were common. Panics destroyed savings overnight. Businesses collapsed under unpredictable credit cycles. In 1913, after one of the greatest financial panics in U.S. history, a group of financiers, senators, and banking elites met in secret on Jekyll Island. Their mission? Create an institution powerful enough to stabilize the economy, yet protected enough to operate away from public scrutiny. The result was the Federal Reserve, a hybrid institution with private banks as shareholders and federal authority as a shield. But here's the twist. From day one, the Fed didn't just respond to the economy. It manipulated it. Interest rates, money supply, liquidity. These weren't reactions. They were decisions, deliberate choices that would shape the direction of the entire nation. And slowly, a new reality formed. The belief that central banks could manage the economy like a machine, but machines break. And in 1971, the entire global system snapped. For decades, international currency values were tied to gold. It limited how much money governments could create. It kept inflation in check. It prevented reckless monetary expansion. But by the 1960s, the U.S. was drowning in debt from war spending and social programs. Other countries realized America didn't have enough gold to back the dollars it was printing. The world began demanding gold in exchange for dollars. Trust was evaporating. So on August 15, 1971, President Nixon announced a shocking decision. The U.S. would no longer redeem dollars for gold. In a single moment, the global economy shifted from a tangible anchor to pure trust in central banks. Money became abstract, debt became limitless, and central banks gained unprecedented power. Now they could create money at will, control interest rates without restraint, and shape economic cycles through policy, not production. This was the moment economic reality became editable, and it didn't take long for the consequences to emerge. After 1971, central banks became the architects of economic reality. Inflation in the 1970s exploded. The 1980s brought aggressive rate hikes that triggered recessions. The 1990s saw financial deregulation and speculative bubbles. The 2000s ended with the biggest meltdown since the Great Depression. And during every crisis, something predictable happened. Central banks gained more power. To stop inflation, they tightened. To stop recessions, they eased. To save markets, they intervened. To rescue failing institutions, they printed. Every solution created a new dependency. Cheap money inflated asset bubbles. Low interest rates encouraged massive corporate borrowing. Easy credit made governments addicted to debt. Quantitative easing distorted markets beyond recognition. And yet, each time the system wobbled, the same group of unelected officials was called on to fix the problem. But here's the paradox. The same policies used to save the system are the ones destabilizing it. And by 2008, the cracks were impossible to hide. When the global financial crisis hit in 2008, central banks unleashed tools that were once considered unthinkable. Trillions in emergency lending, massive bond buying programs, near-zero interest rates, unlimited liquidity injections. What was sold as a temporary emergency measure became a permanent strategy. Then came 2020. Mass lockdowns, economic shutdowns, global uncertainty. Central banks printed more money in a year than they had in decades. The world entered an era economists now call the everything bubble. Stocks, bonds, real estate, commodities, everything inflated. But inflation wasn't the only problem. The deeper issue was control. When central banks can intervene at any moment, when markets depend on their decisions, when entire economies react instantly to a single press conference, who really runs the economy? And more importantly, is the system stable or is it being held together by confidence alone? To understand where we're heading, look at the patterns. Debt. Global debt has surpassed $300 trillion, far beyond what economies can realistically repay. Inflation. Prices rise even when demand falls because monetary expansion distorts fundamentals. Asset dependence. Markets rally not on productivity, but on expectations of central bank support. Interest rate whiplash. The fastest hikes in modern history have triggered corporate defaults and government strain. Currency fragility. Nations once considered stable now face devaluation risks. These are not random events. They are symptoms of a system constantly rewritten, adjusted, and readjusted by central banks. The deeper truth is uncomfortable. We no longer live in an economic system governed by supply and demand. We live in one governed by policy decisions, decisions made quietly, without democratic input, by institutions too powerful to challenge. And once you see this pattern, you can't unsee it. Central banks do not follow the economy, they shape it. Their decisions set the conditions everyone else must react to, from governments to corporations to individuals. Every crisis expands central bank power. Booms and busts are not natural cycles. They're amplified and often triggered by policy choices. When money detached from reality in 1971, economic control shifted permanently. Today's financial world is built on models, expectations, and confidence, not tangible value. We are living in an era where economic reality can change overnight, not because of market forces, but because of decisions made in confidential meetings. If you don't understand how central banks operate, you don't understand the system you're living in. If this breakdown opened your eyes or changed the way you look at the financial world, make sure you hit like, subscribe, and turn on notifications. Because we're diving deeper into the hidden mechanisms shaping your money, your economy, and your future. And in the next video, we're exposing another layer of the system, the cycles and signals central banks hope you never learn. Stay curious, stay aware, and I'll see you in the next one.